So today we'll try to understand maybe a familiar concept for some of us called capital budgeting. So this is a term in finance, and most corporate companies will regularly use this for particular purpose, which we'll discuss in these sessions. So we'll not go in depth into capital budgeting. We'll try to understand what are the basics of capital budgeting given our time constraints, and maybe in the upcoming sessions we will go a little in depth. So first, before I explain what capital budgeting is, let me just explain the scenario. Let me put us in a scenario where this will the context of capital budgeting would make more sense. Okay, so there are multiple scenarios where the capital budgeting is useful. As the name suggests, capital budgeting, right? So let's say you are a company and you have an option to invest. You have a certain money with you, or you have certain ability to invest, and you want to make sure that you invest in the right project, and you have, let's say, n number of projects in front of you that you want to invest, okay, that you can invest potentially. Now given that is the scenario, let's say your budget is limited, right? You can't at times you may not invest in all of the end projects that you have access to, or you can invest into. So you have to choose which one, which of the projects you have to invest into, and which of the projects you should not invest into. Number one. Number two, you should also get a sense of the projects that you are investing into, right? You should also get a sense of which of these projects is more profitable for me in the near future or long term, right? So all those basically those two questions are answered with a concept called capital budgeting. So basically, what are the two questions? One is, which project should I invest and which I should not? Number one. Number two, get a sense of profitability related to each of the projects that you want to invest in, so that you can choose. Let's say now you have gathered, let's say, 2 or 3 projects. All the 3 are, let's say, profitable. Okay, that means you can invest in each of the 3. But which one is more profitable? To get that sense of which is most and least is also the capital budgeting concept will help you. It's not only from the standpoint of corporate companies that this topic or concept is utilized. There are several other cases we typically use this as well. I don't know if you have noticed, but typically in colleges, right, we have different various departments, and there's a certain budget allocated to each of these departments, and these department have their own requirements, right? So let's say if there is a metallurgical department, they have some requirement of procuring some equipment or etc. for lab purposes or some research purposes, which will help in a particular task or a particular project. So there also this sort of concept or analysis can be applied to see which project or which equipment to purchase, how it will impact and all. But the context will change slightly different. It will be slightly different in the academic purposes. So in corporate purposes, you purely most of the times you will look at from the standpoint of profit, right? How much, if I invest this much, how much am I getting in return? But in the academic context, you may not always look at the profit or the return in terms of literal profit, that how much amount you are making out of it. But there your requirements will be something different. You will see how much impact it will, how much need it has at that particular point in time, or what kind of projects it will enable in future. So there are several other factors that people typically use to get to capital budgeting. For example, if you also take another context, like non-profit organizations, right? So there, as the name suggests, they're non-profit. So the factors that they look into will completely vary from the factors that corporates look into, and also the academic institutions look into. So it depends from context to context. But for this discussion, we'll only focus on the corporate related capital budgeting. So their main goal is to which project should I invest in, where I can get maximum or better returns. So that is where capital budgeting comes into picture. So it will help you decide which project is adding more value to the company, and why we need to choose the project which adds more value to the company. That's an obvious question, obviously. We know the answer for that. So typically there are several stakeholders, shareholders, etc. And the more the value that company adds to itself, their shareholders value also increases, right? Their wealth also increases. So that's why company management always tries to add more and more value to the company. Therefore, capital budgeting becomes pivotal for that sort of a mechanism. Now, there are multiple ways a capital budgeting process or analysis can be done, and there are three popular methods using which we can do this sort of a decision capital budgeting process. So first of them is called payback period. We'll discuss this in detail. And the second is called IRR, internal rate of return. Most of you might be familiar with this. And the third is called NPV, net present value. So we'll talk about these three in detail. But before that, let's understand what this means. Payback period is basically, let's say you're investing 1 lakh rupees now into a particular activity, and you are getting certain fixed returns from that particular investment that you made for n number of durations, right? Now, how long will it take for you to recover your initial 1 lakh is called the payback period. How many years or how many periods? Internal rate of return is basically, let's say you are invested in a particular project, and you're also getting certain amount of cash flows at a fixed periods. Now, for you to make sure that the returns that you get in the future cash flows to equate to your current value, right? So whatever the 1 lakh rupees you invested at the initial phase, so if you for that future cash flows to be equated to the net present of 1 lakh, so what is the rate that you will have to you'll be making for that to equate? We'll talk about it in detail with an example. It will be more clear. Basically, that will be called as internal rate of return. And then we have third is called net present value. So what is the present value? So this is based on the concept that there is a time value of money. That means your 1 lakh rupees that you have today is more valuable to you in general than the 1 lakh rupees that you will have in about a year end, right, or later. So there's a certain time value associated with the money, and net present value basically tries to translate all the future cash flows into your current time and show you basically a net how much this project will get you, and or how much you will lose in that project. So that is what is called net present value. We'll talk about these three with an example and understand some positives and negatives of each of those. And then okay, so before we go into those three topics in depth, we'll just understand why is it needed, right? It's a simple point. So far we would have understand by now that capital budgeting, it first accounts for two main things. First of all, it will tell you which okay, if you are a company, that means there are certain stakeholders, right? And they are trusting in you for you to manage the company. So you have to make sure that you make the right decisions for your stakeholders, on behalf of your stakeholders. So capital budgeting will help you make sure that whatever the decisions investment decisions that the company makes is the right decision, and it will help them to explain the same to its stakeholders and shareholders. So there are certain positives and negatives associated with each of the capital budgeting approaches, but keeping that aside, but all of them at a certain level, they will help maintain that accountability by the management. And also it will, as I discussed, it will help them measure, basically get a sense of how much profit will they make in each of the projects that they have ability to invest into. So those are the two aspects with which or why a company does this capital budgeting. Now let me Okay, I've just mentioned all these three topics. We'll not go in depth. I'll share this article with you guys later, but I'll just cover some important topics. Okay. Let me see. Okay, so typically, what just give me 1 second. Okay, some of these are points that we have already discussed. Okay, so what typically it happens is a particular company, depending upon its context, depending upon the factors that play in its investment decisions, it may choose to prefer one of these three approaches. Ideally, all the three approaches on a particular project should show same results. That means if it is profitable, it should show it profitable. If it's not, it should not. And likewise, other aspects that we can derive from these capital budgeting processes. That is ideal situation, but oftentimes it will not be the case for various reasons. We will discuss those in detail in the upcoming points. But that is the ideal situations. And typically what companies tend to do is, depending upon their requirements, depending upon the factors in which they play in, they will tend to choose one or two of these metrics which will work for them. Not necessarily in a wrong way, but given their situation, that there is a particular metric that will portray their returns way more effectively than other two or more metrics. So because of those reasons, because of the accuracy that they want, they will tend to choose a particular approach. Not necessarily all the three approaches are favored by the companies all the time. So okay, so let's talk about first the payback period. As we discussed in the definition, payback period is basically the amount of time it takes for you to recover your initial investment, right? So here, let's say, for example, here we are investing in $1 million in the year 0. That means the time at which you invest, and for the following years, at every year, you are making about 300,000. That means about after 3 years, you make 900,000, and about 1/3 of the 4th year, 3 years, 4 months, you are making about your 1 million is recovered, whatever the amount you invested in initially. So your payback period will be 3 years, 1/3 of the 3 years, 4 months, right? So, and likewise, you can calculate payback period for other projects as well. When you are comparing project A, project B, and see which project has the least payback period, and you obviously may prefer that project which has the least payback period, because you're recovering your investment much sooner in that particular project. So this is the metric which they calculate and use it to compare against projects to make a sense of which project to invest in. Now, a couple of things that this particular payback about this particular payback period approach. First, as I said, each of these metrics are preferred by a particular situation. So typically, payback period is preferred by companies where liquidity, that means the amount of cash that the company holds at its for its activities, right? So if that's a major concern for the company, then this particular payback period approach is typically used by the companies. Reason, because let's say if you recover your investment, let's say your $1 million that you have is a limited resource for you. That means you should try to recover that as soon as possible, so that you will have you can invest in some other project. That's why when liquidity is a concern, if companies tend to look at this particular aspect as a major prefer to this particular approach to make their capital budgeting decisions. Can
we look at an example, Jagdish, if it's okay with you?
Go ahead.
So can we think of some examples where, real life examples where maybe we would like to use the payback period based on the criteria? I think the question is not just for you, Jagdish, it's for
Understood.
everyone.
Okay.
capital intensive projects are a very good example of this. There will be lots. Yes, is the question clear?
Yeah.
Machinery in factories. Machinery in
Sorry?
factories. Machinery
in factories. That's a good way to look at it. Yeah. Machinery in factories, right? So basically, the larger the machinery, the more important it is. I think particularly. Okay, so can you just add any more color to it, Sanjay?
Yeah, usually any manufacturing factory initially has a lot of investments, right? Especially when it comes to technology and setting up stuff like the factory, all of that. So all of that, they would probably like a term to pay that money forward, because it will take some time for them to start getting return, and if they won't be in a situation to pay upfront initially itself. So if it's phased, it will be easier for them to pay it back.
Okay. All right. So particularly, you see examples where, for example, the company is really trying to grow, and for them the growth in this particular case means that you have to keep reinvesting, okay, into newer like you mentioned, either machinery or many case stores, right? So for example, you have let's say you're opening stores, right? So in a case of a retail store, the capital expense is about either buying that property, right, or renting that property and doing all the interiors, right, and then stuffing it with all the inventory, right, which is all capital intensive, and of course hiring as well, initial part of hiring. So that is also capital intensive. Okay, let's say, so we have seen was it you who we some time ago we looked at Starbucks? Was it Starbucks? No, it was
I did look at Starbucks, but it was not me.
Okay, no, you were also involved, I thought.
Okay.
So we had what was that? There was this Mexican Chipotle. What's a Chipotle?
Yes. Yeah.
We looked at
Chipotle,
Chipotle,
yes.
if you remember, right? So we had looked at how the company will grow in terms of number of stores, etc. Even now, I think here a lot of companies have chains, and these are like growing and so on, right? So in those cases, what you would look at is, see, if I invest now, right, when will I get the return on this, so that I can start to use that money. This store will no longer be a money guzzling project, but will start to give me money. Okay, that's a good way to look at it, isn't it? Otherwise, we have to keep investing into it, right? So this is one example. See, another example would be, you take real estate projects. The real estate projects are huge money guzzlers, right? Why? You have to buy land to start with, and you have to invest into the the architecture and the buildings and the landscaping, all of that stuff, which is all, it takes money, right? But if you are able to sell that property to enough number of people, at some point in time it will pay back the money, and after that it will all start giving you money, right? So there is a certain amount of payback for it, and after that, see, you can only start to put money into a different real estate project, right, only after the money has been paid back and you don't have any more loan from that particular venture, and now you can put that money into a different venture, right? So let's say, is it is it 3 months, 6 months, 1 year, 5 years, or is it 200 years? In some cases it is 200 years also. Right? There are people who have gone bankrupt because they didn't analyze the payback period appropriately, where it is 50 years, 60 years, etc. And they still are putting money into it, right? Without realizing, oh, it takes too long for them and it is not viable. Any other examples you guys would like to give?
Generally, payback period is used when liquidity is a constraint. That is when people go towards payback period. Else they'll mostly prefer NPV. In this case, say for example, there is some, and mostly it's also used for smaller projects. Because the longer one has an interest component to it that becomes huge. So yeah. This is what I understand. So anything like, say for example, in a small restaurant, they already serve dosas, right? And they want to open up a shop, a small counter for idli, right? So they'll purchase a idli machine, right? So how much? So for 1 year, how much is it going to take for handling the cost of the idli machine, and how much it's going to give us? So if you just take that and subtract it, you get a profit per year, right? So that way you can calculate in how many years you'll get your investment back, something like that. Maybe years is not the right term for this, maybe it's months.
Maybe months. See, when liquidity is a constraint, means what? There's no money. Right? So so take the like Sanjay had mentioned, so when you have like large machinery that you want to buy, correct? So this is going to take multi-years, and it takes huge amount of money from that particular organization, right? Oftentimes they take a loan, etc. Many times it's not even available, right? Sometimes it's not even available. Take for example, I think in this particular case, I think take movies as an example, which is a very risky project. Right? The payback is usually, if it goes well, you get all the money in a week's time, right? If not, it goes longer, etc. So the riskier it is, I think, so in that particular case, the payback period is not a constraint at all. So they won't look at it like that. Because typically where the return is much lower and it will take much longer for you to get, that is when the payback period makes some sense. Yeah. Okay, all right. Jagdish, back to you. Anyone else wants to add before we go to Jagdish?
One more small thing. So typically on the NPV calculation, right? So you have anything that is after the payback period is over. Also, if you have more returns, that is also considered for the calculation, right? But here, so you only take it into consideration up until the point where you get your investment back, right? So that is why the focus is on the the liquidity crunch. If there's a liquidity crunch, can we make it till we get the investment back, right? That is what this metric helps you get. So if there is no crunch, then really you shouldn't be looking at can we get the investment back. You should be looking at where should we invest in so that we can get the most out of the money that we have, right? So that is the difference in the payback versus the NPV.
Right.
Okay. All right.
Yeah. So, Sinha, thanks for bringing that point. That's exactly one of the key drawbacks of considered for payback period also. So that obviously. So let me start with what Sinha has mentioned. So what it basically Sinha is telling is, let's say it's after 3 years, 4 months, we will recover our money. But after that, we are still making some amount of money. It's about 500K we are still making. So that is adding into the profit of the company. So we have invested 1 million now, but whatever that 500,000 extra we are getting, so that is adding additional value to whatever the company currently has, right? So payback period is not able to calculate that additional value, not able to capture that additional value, basically that is getting added into the project. So that is one. Remember the activity, the 2 questions which we started with, capital budgeting. One is to see which project is making sense to invest or not, number 1. Number 2 is, once we identify the projects which make sense to invest, like what is the amount of profitability, what is the profit measurability among these projects, so that I can have a priority. Maybe if needed, I can invest in the project which makes more profit. So that measurability is something that is not captured when we just give that payback period. So that is one disadvantage. And other disadvantage, typically not disadvantage, but in the approach, is that we see here 300,000 in year 1, year 2, year 3. It's not discounted, but usually. But yeah, there are approaches also. There are some modified payback period approaches where they can also discount the future value that they are receiving using time value of money and slightly get it more accurate. But the issue that Sinha mentioned is something that it still holds, that it will not exactly give you the measure of true profitability. A good example here would be this one. See, look at it. This one here, they've invested $1 million at year 0. And they are getting 250 for until a year 4. Okay, that if you compare this particular inflow with the previous one, the previous one is taking about 3 years 4 months to recover the initial account money, and this particular project is taking about 4 years to recover the initial money. But if you look at the after the payback period, from year 4 and year 5, here we are making about 500,000 additional value. But here in the year 5 alone, we are making about, if I'm not wrong, that is, I don't know, 15 million. So that means this particular additional value. So project B, this particular project makes much more profit than project A, even though the payback period for project A is lower than the payback period for project B. So that is the factor that typically gets missed out in the payback period. So that's why it's not. And there are some other complications as well that typically I get into. Will not go into all those things at the moment. Yeah, so that is on payback period. Now moving on to internal rate of return. So this is a second approach apart from payback period. So before I get into internal rate of return, let me just explain a concept called, in simple terms, the cost to capital, right? So internal rate of return and cost to capital both are needed to apply or follow this particular approach. So let's say you are a company and you want to invest in a particular project by raising some amount of capital, right? So when you want to raise a capital, there are multiple ways that you can raise. Or if a simple can be, you can take a loan, right? Take a loan for 1 lakh. You have to pay interest every year on that particular 1 lakh at whatever the interest that you have taken. Let's call it 10%, right? Now once you invest that particular 1 lakh rupees into a particular project, you would obviously expect that particular project to make more return than the 10% that you're already paying to your bank, right? Simple logic. Now, typically, the capital that the companies acquire will not be as simple as loan. At times it will be, but at times it will be way more complicated. So it will involve several components. So as a part of it may be from loans, a part of it may be from certain investors who will have their own return expectations on their returns. And some of it may also be from the company may also find a way to raise it from stock markets, right? So there also shareholders will expect a certain dividends, certain returns there also. So the entire capital may be split up. It may be acquired in parts from various sources, and each of the source has its own return the company has to pay. That means it's a cost to the company for raising that capital. So there is a particular concept or calculation called weighted average cost to capital. We'll not go into in detail, but it will give you basically what is the cost that you are raising the capital at from various sources. So what is the final cost that you are incurring for raising that much amount of capital? And internal rate of return is basically you will now keep that cost that the company is incurring to raise that capital, and it will now compare that with the returns that it will get from the project that which it invests the capital into. So here internal rate of return, it's again a different formula. So first, so let's say, let me come here. Assume you have similar structure of cash flows, invested 1 million at the year 0, and we are getting 300k for the 5 years following. So we can for me to make all these 300,000 that I'm receiving for 5 years consecutively, to equate that to $1 million that I'm making at the year 0. So what is the rate that I should use, which I'll call it internal rate of return, so that all these in cash inflows will be equated with my investment that I made. So typically the formula will look something like this. So this is slightly on a similar basis as we will use a similar concept in NPV as well, but we'll discuss that at the later time. But so what we have here is C0 is the initial investment that we made, $1 million, and CT is basically the money that we make at the end of each period. In this case, 300,000 at the end of every year, and IRR is basically on the left hand side is basically it should be 0. Basically, all the investments that the investment that I make should equate with all the cash flows that I generate over the years. So the only variable or the unknown here is IRR, and we'll use this formula to calculate the IRR. And once IRR is calculated, so we'll compare that with the cost that we are incurring as a company to raise that capital. If that is great, if my return is greater than my cost, then that project is viable. It can make potential. If it is less, then it is not viable project, and it doesn't make sense to invest into the project, because we are not even generating enough money to meet the cost that we raise the capital at. So that is the main concept based on which this IRR, internal rate of return, works. Now, one advantage for this IRR in the corporate environment is that typically the company's capital structure, right? What I mean by capital structure, like what are the different sources that it has potential to raise from, and how much it can raise from each of the sources. Maybe in simple terms, that's called capital structure of the company. Since that will tend to be almost similar, it will not change drastically. Because of that reason, people get a sense of they have the flexibility to have a unique or not changing cost of capital. So they can compare IRR for various projects to a single unique number of cost of capital to get a benchmark comparison of one project with the other project. So this is the advantage that IRR approach has. It will basically allow you to compare multiple projects in a single company and get a better sense of comparison across these projects. Given that advantages, it also has its own drawbacks. So just like payback period doesn't capture the full measure of profitability, right? So here also we are seeing the IRR, but it doesn't fully capture the again the sense of profitability. We're still not capturing the amount that it is making, how much value it is adding. We are just getting a sense of is it viable or not, but we are still not getting a sense of how much it is adding more value. So it will further go into few more complications when your cash flow is not as simple as this one. Here we have a simple cash flow where we are invested at time 0 and getting a fixed amount at following periods, but usually that will not be the case. As Chaitanya was also talking about earlier, you may have to reinvest amount at regular periods again, and you will not necessarily get the money same amounts at every frequent times. So there are a lot of complication that will happen, and that will in such sorts of situations, IRR typically is also not that favorable in giving us a better and accurate comparison across projects. And then there is third and final one, which is usually recommended and most followed, as Sina was also talking about, is the net present value approach. So here what they do is, remember the cost to capital that we just discussed. So they discount the cash flows that they get at each and every year with this particular rate to the current value. What do you mean by discount the cash flow? That means they are translating the future value, currency, money that they are getting to the current time. So what this 300,000, what is its value at time 0, at the time of investment? Likewise, they will translate all the future cash flows at the rate of cost that the company is incurring to raise that capital. So once they do that, they will get a sense of what is all these future cash flows present value is at the time of investment. That is what they call as NPV. And here the decision on which we will make, or the criteria on which we will make decision is if the net NPV of all these future cash flows of the particular project is greater than the initial investment. That means that particular project is profitable. If it is not, the project is not profitable and it hence not viable. So that means if it is greater, they can go ahead with the project potentially. If it's not, they should drop it. That's the decision making that which they use. Now look at this particular example which they have given here. Assuming that at a discount rate of 10%, that means assuming that cost to raise the capital for the company is at about 10%. Project A and Project B, these are the cash flows it has, and net present value for Project A is about $137,000. Hold on, let me. Okay, it's a different. Let's focus on these numbers here. So let's assume Project A and 137K and Project B as roughly about $1.3 million. We can get a sense that both are profitable. Number one, like which project I can invest and which project to not invest. Question number 1 is answered. Question number 2 is sense of measurability, right? So which project should I prioritize if I have to only pick one project? So obviously Project B has more profit that is being added when compared to Project A. So we are also getting that sense of measurability, so we can prioritize our investment decisions. So that is why, and it will also tend to work if you look at here the cash flows. In year 2, we have no returns that we have generated, but we are investing another $300,000. So even when cases are something like that, such complications arise. It's not purely a return once after initial investment, but there are multiple investments at certain phases of the project. In such cases also, NPV tends to take those into account properly and give you the right sense of which projects to invest in and what is the profitability that each project can potentially add. So there are certain points that they talk about, like typically it will not take into account overall magnitude of the project. That means overall how much amount. So for example, it will give you the net present value, but it will not give you the amount of investment that it is made into the project, how much investment are we making to generate this value, etc., etc. There are points considered as minor drawbacks, but there are also methods that which they can use, something called as profitability index, which we'll not go into now, maybe for some other session, which can potentially give you a sense of all those concerns as well. So yeah, so net, so we have looked at the capital budgeting concept, and there are the 3 popular methods that are typically used, and we have seen drawbacks for both payback period and internal rate of return, and their own advantages where it can be used. And we have also seen the net present value, which is usually considered as superior to the other 2 approaches, and giving us sense of both the important questions that needs to be answered, which is viable, which project is viable or not, which investment is viable or not, and the sense of priority of the investment in terms of how much profit it can make. Yeah, we'll stop it here. If you have any questions, I'll be happy to take them.
Yeah, just add one more small stuff.
Go ahead.
Yeah, and IRR, the limitations, right, is, so there are like 2 main limitations. So one is it's a mathematical limitation of the way it's calculated. So if there are all the negative cash flows come first and then comes all the positive cash flows, basically you invest and then you get returns. If that is how it is, then it is still okay to use IRR. The problem comes when the cash flows get juggled. So there are some negatives, some positives, some negatives, some positives. In that case, it is possible to get more than one IRR for the same set of cash flows. Okay, so it becomes confusing. So which is the right one, right? So that is one major drawback. When there's so when the cash flow directions are not streamlined, right? So if it is juggled in between, so that becomes a problem. Another one main limitation, for longer term projects is that the discount rate, right? So IRR, in IRR, you are calculating a discount rate, right? So you have the investments, you have the returns, and you calculate what is the rate of return. The problem really with that is, see, it gives you one rate of return for the whole project, right? But in case of an NPV, you know that the discount rate will change year over year, right? So the cost of capital for you will change over time, right? So IRR doesn't take that into consideration. It tries to fit your cost of return into a single number, right? So if you need the flexibility to change your discount rate and then evaluate your projects, so I'll be able to raise cost at so and so amount for the next year, at even lesser amount for 3 years from now, and if you want to incorporate that into your analysis, then IRR cannot do that. So NPV has to be used for that. So that is another big limitation for IRR.
Okay.